What's up, Hot Sauce? I am Alicia Shepherd with the Commercial Blueprint, and today's guest needs very little, if any, introduction. If you have spent any serious time in the commercial real estate industry, you're going to know who this guy is, but he deserves a proper one. Today, I'm sitting down with Bob Knakal, a name synonymous with institutional credibility, market-making deals, and doing the business at the highest level for decades. Bob isn't just a producer, he's a market historian, a relationship architect, and I think one of the clearest examples of what I know happens when discipline, data, and long-term thinking compound over time. Bob's career spans multiple cycles, multiple market resets, and millions, actually billions of dollars in transactions. And what's always stood out to me is this: Bob seems to never chase noise. He builds trust, systems, and insight that outlast trends. So on today's session of Commercial Blueprint, we are going to talk about what actually moves the needle in this business, what becomes durable in a market like we're facing today, and what repeatable behaviors look like that separate professionals who survive cycles and who become leaders in an industry like Bob. He's the embodiment of that distinction. Bob, I am so genuinely grateful that you're here today. Let's get into it.
Let's get into it, Alicia. So great to be with you today. Thank you so much for having me on.
Absolutely. One of the things that I know I want to kind of start our conversation on, because I think it's so iconically Bob Knakal, is your map room. First, let's talk about what it is and how it came to fruition, but I'd love to understand, what is that done to support your growth and success over time? So you have a map room. I think that's the coolest room in commercial real estate. How'd you build it and what led you to do it?
Thanks. What led me was a basic premise that I have lived by for 42 years in the business, and that is that we're not in the real estate business, we're in the information and relationship business. So
Yeah.
I've always tried to have a perspective on the market that is statistically based. As brokers, the most frequently asked question we get is, how's the market?
All the time.
99.9% of brokers answer that question with adjectives. If you can answer with statistics rather than adjectives, you seem a lot more informed. And I think people will believe you can help them make better decisions if you really understand the market from a statistical perspective. So with that being the case, I have changed my focus the last couple of years. I have really transitioned more from being a generalist in the investment sales market in New York City, selling all types of properties, to really focusing on three very distinct verticals, all of which are highly correlated and synergistic. And they all have to do with vacant buildings in New York. So what do you do with vacant buildings in New York? There are only three things. One, you knock it down and build something new. Two, you renovate the heck out of it and change the use from one use to another. Or you sell it to a user, and that's a buyer occupant that's going to buy it and then occupy it for their own business. So the biggest part of those three verticals that we play in is the new development market. The map room really was an outcropping or a result of the fact that for many, many years, I've been very frustrated that there is not really transparency into what is being constructed in New York. The one market sector where we have a decent level of market data is in the residential condominium market. But, broker, and every residential broker does a market report on this. But broker A will say there's 9,000 units in the pipeline. Broker B will say there's 6,000 units in the pipeline. Two great firms. How could they be so different? Well, it occurred to me, it depends. When do you start counting units? When do you stop counting units? When does
And these are all in the multifamily space.
These are all in the condo
Yeah.
market space, and virtually nothing on apartments being constructed, hotel rooms, office space, and then miscellaneous, the fifth miscellaneous bucket, which includes educational properties and healthcare properties and things like that. So 10 years ago, I said, boy, I just wish I could go out and count the buildings, because when you look at something and you can see there's a crane lifting buckets of concrete up, it's under construction. And when that's not happening, it's not under construction. I said, it's got to be easy to do, but who the heck has the time to do it? So pandemic comes along. New York City was an absolute ghost town. There were no cars moving, no people moving, no stores were open. And for whatever reason, it occurred to me this would be a perfect time to go count those buildings. And so I had my team put together copies of the Sanborn tax lot map. I went out and I spent 4 months, 220 hours in the field, walking every street of Manhattan, south of 96th Street on the east side and south of 110 on the west side. The result of that was I brought these sections of the map out into the street, and I would highlight things as I saw them because I didn't trust myself to write neatly enough to understand my writing if I'm scribbling on a pad out in the street. So I
Yeah.
figured highlighting would be easier, never intending to create a giant map. I then took information from the map, made notes, and then did research. I started taping sections of the map together to see what was happening in certain neighborhoods. And before I knew it, I had this map that was 24 feet long and 10 feet wide. We identified every site that was under construction, every site that had been demolished, every building that was built to less than 25% of its max density. We have an as of right zoning jurisdiction in New York, so what the density capability of every parcel is. So we looked at the sites that were underbuilt by at least 75%. We looked at potential assemblage opportunities. This is all color coded on the map. So from that, we were able to produce a supply pipeline of what was under construction and have that nailed down to the square inch. We
That's
have it
amazing.
disaggregated into those 5 buckets that I mentioned: residential rental units, condo units, hotel office, and miscellaneous. We have each of those buckets broken down into 3 different segments. One is pending bucket. So a developer buys a development site. Usually they go through about a year of planning and permitting. That's a pending in the pending bucket. As soon as they get their construction loan, they're going to start construction. So as soon as they get the construction loan, it flips from the pending bucket into the active bucket. And then when different property types hit different thresholds in terms of renting or sales, it flips into the completed bucket. So we have the pipeline nailed down beautifully, and we've been tracking everything in terms of permitting and then everything since we did the field work. We've also completed a 3-year study of every land sale that's happened in Manhattan going back to 1984. It's over 2,500 sales we've analyzed, broken down into the same 5 buckets. The Knakal Map Room is a place where folks can come in, understand every aspect of what's happening in the development market in New York City and see it on a old school analog map. And people look at different neighborhoods and where they're doing projects and where they grew up and everything else. And it's been a truly game changing resource for me. Over the course of my career, I've given about 10,000 pitches. I've won about 26% of them. In the map room now, we've given 78 pitches. We've gotten 76 exclusives. So it's more than a
I mean,
90
that's amazing.
rate. Yeah, it's really
That
been.
level of clarity, even just hearing you talk about it, like, at a granular level what data went into it and what result can come out of it. That's incredible.
Yeah. So, like I say, we're in the information business. I think when it comes to the land and development market in New York City, we have better information than anybody by far. I think that's
Uh,
why the win rate has been as high as it is. It's hard to dispute that we know more about that market segment than any other broker in town.
I mean, you walk them into a whole room that is visually telling the story of the market. I don't know how you compete against that. And your
Right.
numbers show that it's hard to compete against.
Yeah.
And that's awesome. That level of clarity is something I think that now with computers and AI and digital, I think the noise around us encourages agents, whether they meant to or not, to like get lost in the sauce around all of this information that's available. Where if they just dialed it in with extreme clarity, and I love that you broke this in 3 verticals with 5 core product focuses in it, and you're really clear how those play together. That's awesome. So, I mean, if we look up at the market right now, we're in a market cycle, in a downward market, if not toward the bottom of it. When you look back across multiple market cycles, what are the earliest signals to you that a market is in recession or in its growth before headlines catch up and before like we start talking about it?
No, yeah, well, that's an easy one. And I have been through several market cycles going back to the S&L crisis in the early 90s, the recession in the early 2000s, the GFC, 08, 09, and then
Yeah.
what I referred to as the Great Slog, which I think we're coming out of now. I think when you look at indicators that tell you the market is changing, there are 2 market sectors that we look at that are very telling about changes in the market. And in New York, and probably in other places as well, it's the hotel market and the land market. And why are those 2 sectors predictive of changes? Well, hotels are highly, highly reactive to changes in the marketplace
Yeah.
because leases in hotels are only for one day. So the performance of hotels really is a great proxy for what's happening at that particular moment in time. And then the land market, which is indicative of the optimism or pessimism that developers have about market conditions, not today, but 3 or 4 years from today, when what they're building is going to come to market and they're going to have to rent that space or sell that space. So those two sectors have been really key in terms of helping us predict when the market is coming out of downturn. And what I'd say today in New York, we're in uncharted territory for sure. In all the downturns that I mentioned, all properties were losing value, just to different magnitudes. Today, we have different market sectors moving in different directions at the same time. Our retail properties are on fire now. They started to be negatively impacted well before other market segments, but leasing activities picked up, investor demand is back, and that sector is very strong. Our industrial sector is strong. Land is doing really well. Our hotel market is performing better than any other sector. We lost about 30,000 of our 130,000 rooms to alternative uses. So that market is doing extraordinarily well. Our office sector and our multifamily apartment building sector both have been struggling. And each of those, similar to the way the broader market has been moving in different directions at the same time, we've seen the same dynamics within these two sectors. And these two sectors are important because we have more apartment buildings than any other type of building in New York. And the office sector is a very significant sector as well. In office, we are past the bottom. And to look at the two different sectors within office, we have a new Class A office construction is doing extraordinarily well and has for a while. Seemed like if you build a new office building anywhere in New York, you could get triple-digit rents. But our B and C office stock was getting slammed. The same buildings we were
That's
selling.
interesting.
Yeah, same buildings we were selling for $800 and $900 per square foot. 5 or 6 years ago, we're trading in the 300s per foot and the 200s per foot, and even a few deals that happened below 200 a foot. So significant diminution in value. Though that sector is starting to recover, it's hard to find anything priced in the 300s today. Most things are trading well into the 300s or in the 400s. So that market is off the bottom. And then if you look at our multifamily housing stock, new construction, Class A, and free market apartments are doing really well. Two things that have impacted supply in the market: our new tax abatement program for new construction is woefully inadequate and misguided and has not produced nearly the amount of new construction that we need. And secondly, our rent laws that were changed very significantly in 2019 have created a situation where owners are nailing the door shut on tens of thousands of vacant units because it doesn't make sense to renovate them. This constraining of supply has exerted tremendous double-digit increases in free market rents in Manhattan, to the point where it's absolutely crazy. But the free market apartment building market is doing well. Cap rates are down because rents are going up so significantly. But the rent stabilized housing stock continues to get beaten to a pulp, and probably will continue to, based on the new administration that has pledged a rent freeze in these buildings, where expenses are going up at a higher rate than they ever have. And if you don't have revenue going up, you have a whole class of buildings where your net income is going to go down every year. So
Yeah,
lots of
just
challenges, lots of challenges in that market.
if I want to go back to office for a second, do you think that the office is feeling that downward trend because prices got over speculated and this is just market correction, or is it genuine like devaluation that's happening?
No, I think it's two things. One is that the basic demand for office changed very significantly during COVID. There are a number of buildings that are still trying to recover from that. We had a lot of new construction built in the last cycle. We have had an interest rate environment that has changed very significantly. So you look at all of those factors, and it's tough to make those buildings work. Something that is helping the market significantly. There was a point about 3 to 4 years ago, we had 100 million feet of office space vacant in New York City. There
Oof.
are only 6 cities in the United States that even have 100 million feet of office. We had 100 million feet vacant. Smartly, our policymakers implemented a tax abatement program for the conversion of older or obsolete office buildings into residential. And so today we have 84 office buildings in New York that are being converted to residential. That's about 25 million feet. So leasing activity has picked up. We've had all these conversions. So we're now hovering around 65, 70 million feet of vacant space, which is down significantly. And, we're starting to see leasing activity, particularly in B and C buildings, picking up nicely.
Well, that's I'm glad to hear that. I mean, those are all indicators too that kind of give a point that the market is in a recovery phase, which is great. When you look at this downward and recession in the market, what feels structurally different about this cycle compared to maybe past slowdowns or reset that you've gone through in your career?
Just like I said, you have different market segments moving in different directions at the same time. I've never seen that before. And I think
Yeah.
a lot of that is caused by the fact that, the old traditionally markets moved with supply and demand, and our rent stabilized housing market moves in concert more with public policy than with supply and demand, which is really not good.
Yeah.
So you have things like that. And then you have, broader demand drivers that are a little all over the place. And so you have different markets moving in different directions. Generally, I think the market is coming back and swinging up and doing better, but there are still segments that are facing headwinds.
Absolutely. And I think that's nationally. I practice in Los Angeles, even though I live in Austin, and some of those same constraints, like the mass amounts of office being vacant when cities don't even have the same amount, that's really deeply felt because if it's impacting that office space, it impacts the businesses that were there, and that ends up impacting the people to take paychecks home from it. If you look at it, I think a lot of people are pretty quick to blame debt in the moment we're in right now for why things aren't recovering the way that they want or why deals are getting stuck. When you look at liquidity and debt around real estate, what are you witnessing on the type of real estate you work with?
Well, again, it depends on the type of property. Most of what I do is development and redevelopment today. So construction lenders are doing really well. They're making a lot of money. They're putting out as much money as they can. The risk return trade off seems to be pretty good there. But then you look at a market like, again, going back to rent stabilized housing, values are down 75% in that space.
Yeah.
Most of those buildings were leveraged by only 50%. But even if you were leveraged at 50%, if values went down by 75, all your equity is wiped out. The debt
Yeah.
is 50% impaired. And because of the liabilities that are associated with these buildings, the owner who has no more equity doesn't want the building and has no incentive to invest in it. The bank has no desire to take the keys back and get in the chain of title. So they're like, I call them zombie buildings. They're like orphans. Nobody wants them. Nobody wants to invest in them. And until this the day of reckoning where all of this stuff is going to be sold at the market clearing price, and that's going to be a sad day for a lot of lenders. Lenders will go out of business when that day happens because they're carrying stuff on their books at well over what it's worth. It's just based on the fact that if we do have the rent freeze that the new mayor is pledging, I think values rather than being down 75% will be down 85 or 90%. And it's just going to be a
That's a
very
big
nice
thing.
people.
I mean, as you're talking to the owners inside that real estate, how are they emotionally accepting or dealing with that type of reality around their investment property?
A lot of them who were not diversified that had mostly stabilized properties are buying houses in Florida so that when they go bankrupt, they at least won't have their house taken away.
Yeah,
it's a
they've got something to fall
significantly
back on.
horrible, horrible, horrible situation for a lot of folks, all based on changes in public policy.
And what ifs? I mean, that's still a what if it comes to fruition or not. We had it in Los Angeles right before COVID hit, a solid year where the multifamily market just stopped and it was like a full halt because of legislation around Costa Hawkins, which it was, is this going to get repealed or not? And that was going to deeply impact rent control and rent ordinances on every multifamily building. So until they knew the answer on that, buyers stopped investing, sellers got stuck. And if they needed or wanted to sell, it was at a massive diminishment of value. When you invest, it's very sad to watch that happen. So that's someone's like legacy that you're messing with at some point. Well, okay, I'll pull us out of the what if on the downward side. You look at the market. What do you think the next 12 months looks like?
I'm very bullish. I'm very bullish. Last year in Manhattan, we had 681 properties sold. That was about 2.5% turnover rate out of the 27,649 buildings we have in Manhattan, south of 96th Street. That makes the seventh year in a row that we are at or below trend turnover. We've never seen that before. We've had, as many as 4 years in a row below trend. Namely, that was going back to the savings and loan crisis in the early 90s and again during the recession in the early 2000s. But those are 4 years max. We've been 7 years. So I think the market is poised to really explode in a positive way in terms of volume. I think values have to go up, for for a couple of years now, we've had some asset classes where you were able to buy properties on a price per square foot basis at the same level you could have bought them for 25 or 30 years ago. So I think values are going to recover very nicely, and I think activity is going to pick up. And I'm very, very bullish on what market conditions are going to be like for the next couple of years.
I think that's great. I think there's multiple cities across the US that their data is telling the story that everyone's ready for this to turn upward and to start recovering. And I think if debt markets can solve themselves at how to control interest rates at a reasonable and sensible level, that only contributes to a successful turnaround.
Yeah, but I'm not banking so much on interest rates helping out. It's important to remember that over the last 50 years, the average 10-year treasury is 5.4%. We've
Yeah.
been well below that for quite a while. Even with the change in the Fed, I think that, maybe we get a little bit of relief, 25,
Yeah.
50 basis points, but I don't think we're getting back to the point anytime soon where interest rates are 3% unless there's some kind of a global economic calamity.
Yeah, I mean, I think if we can get back into the fives, we're wildly healthy. I think agents and especially investors forgot is when we're in the threes, that's an economic band-aid. That wasn't designed because that's where interest rates are healthy. That was designed because that's how they kept from things getting really unstable inside the economy. So
Right.
if it just got to the fives, I think that'd be awesome. It'd be really great. I mean, you have your brokerage going now. I'm sure you have younger or new agents jumping in. You see the opportunity in the market that's coming in the next few years. How are you coaching or consulting them to not make some of the really mistakes that we see young brokers or new brokers make when the market's great? They have all the opportunity, but they're tripping on themselves a little bit. How are you coaching your agents around
Yeah,
that?
well, Alicia, it's all about fundamentals. Like I always say, the brokerage business is a very simple business. It's
Yeah.
just very hard. And so we really just teach the fundamentals of having your target potential clients, your list, going after them over and over and over again with good information, valuable information, building relationships, meeting with people, doing your networking, creating content, being out there, being helpful, making your calls, logging your connections, all those basic fundamental things. This is not rocket science, but you have to have the discipline to not chase the shiny object all the time and do fundamentally sound things, understanding that if you're doing the right things and you do them over and over and over again, eventually they're going to work for you. So I just try to drill the fundamentals into the folks that are working with me and hope that they are able to use discipline well enough to stick to that.
What's a shiny object in your mind?
Well, the deal where I could make money. If you say, I want to do deals that are blue and you see a green deal, it's tempting to go try to do that. But that's taking away time for you building your reputation and track record with blue buildings. It's very easy. People often say to me, hey, BK, but why can't I work? I could make money on that deal. I said, yes, you could also go buy some cocaine and cut it up and sell it on the corner and make money too. But is that going to help you get to the top of this business? I mean, if you think about it, I love Jim Collins' book, Good to Great, where
Yeah.
the main thesis is main difference between good companies and great companies is the great companies figure out what they can do better than anyone else in the world. And every decision they make about what they do, don't do, how they do is based on trying to achieve that position. So, I always tell folks that, look, you have to be a specialist. You have to be an
Amen,
expert
man.
at what
Yeah.
you do. And to be an expert, I use the analogy of a doctor. Let's say you're out running and you rip the ACL in your knee and you go see two doctors and one says, oh, you ripped your ACL in your knee. No problem. I've done plenty of those. I do knees, I do ankles, I do hips, elbows, wrists, shoulders. I can do it
Don't
all.
want that guy. Yeah.
Or there's somebody says, "Yeah, well, I've done 9,324 knee ACLs. It's all I do." Where are you having your surgery? So if you're somebody who says, "Hey, I want to go try to make money doing knees and doing elbows and shoulders and wrists and fingers and everything," you know
Yeah.
what? You'll be okay, probably, but you're never going to get to the top of the business because in order to really get there, you have to become known as the go-to person for a certain type of transaction or something in a certain location or whatever your niche is going to be. But you never get there if you try to be everything to everybody. So yeah,
Amen.
Yeah, being able to say no is a key ingredient. So that's what we try to teach the folks is to have discipline. Don't chase the shiny object. Don't chase the green deal if you're trying to do blue deals. It's hard. It's very hard. It's tempting. It took me 2 years of continuing to go for that green deal when I knew I shouldn't have. But finally, after 2 years, I'm to the point where I'm saying no a lot more than I'm saying yes. And it's been very, very accretive to my business.
I love that. I teach that in our training company, but I love that you broke it down to colors because that makes it so easy to like visualize that. Most people, especially in tertiary markets, they think that their only option is to go generalist, but that's not the truth. You could go larger geographic territory with a defined product, just specialize in that. I mean, your map room is specialization at the very highest level because you knew the numbers. You can get into the weeds of what that is and you're specific about what it's not. I think that's
Yeah,
really
and I think it is very, very challenging if you're in a tertiary market.
yeah.
Very challenging to be an expert at one thing. And in a dense market, big dense market, it's very easy.
Yeah.
More challenging in a tertiary market. Do you want to just try to do everything within your market and be the market expert, or do you want to increase the geography of where you are, where you're operating, and just try to stick to one type of
Yeah.
deal?
I mean, I think triple net teams, Chris Sands' team, Sands Investment Group, they're a great example. They go all in on triple nets. They have agents deployed everywhere, and their geographic territory might be big, but their brand focus or their focus on triple net product is extremely clear. So they're just eat, sleeping, and breathing that. And that's why he got to the success level that he got at because he knew how to make that win for him, for his
Yep.
people. You have agents in your office, and even for yourself or agents that are listening to this, investors too. What would be the metrics that you would tell people to watch the data on right now so that they can kind of better guide themselves through market movement?
Well, I think it depends what you're trying to achieve. If you're a broker, you want to look at the two V's, volume and value. On the volume side, you're always looking at dollar volume as well as number of properties traded. I've always said of those two, number of properties traded is always more indicative of market activity because you could have a couple of very, very large transactions that totally skew the market. Look at volume and then look at value. How are values changing?
Yeah.
And depending on what market you're in, like if you're in the multifamily market, people talk about cap rate, cap rate, cap rate. I say, you know what? You have to look at four metrics in multifamily. It's not only cap rate, it's gross rent multiple, it's price per unit, and it's price per square foot. Can't just look
Yeah.
at one, you have to look at all four of them. So you have to
Well,
know
I like
numbers.
that you're saying take out the outliers because those big mega deals can skew the numbers massively, and a portfolio deal can. So if you really just focus on the straightforward deals versus the larger ones that maybe have metrics that blow you out of the water,
Yeah,
that'll
look,
help you.
I always use as an example 2009 in New York, where there was one transaction that represented 14% of the dollar volume for the entire year. You have to look at number of properties sold, much more indicative of market activity than dollar volume is.
So if we look forward like 5 years from now and we're studying this cycle, what will the best operators and investors have done right now differently than everybody else?
Today, I believe in New York City anyway, and I apologize to keep going back to New York, but I only operate in New York. I don't know anything about any other market, but I think it's the buying opportunity of a lifetime. I think that 5 years from now, people are going to say, why didn't I buy everything in sight? I think there's already some buyer's remorse that they didn't buy more over the last couple of years, but I think that values are going to be up very, very substantially. And, I say buying property, and this is just my observation because I've never been an investor in real estate, but buying property takes two things, capital and courage. If you have the capital, that's one thing, but you have to have the courage to buy when it seems like it's a tough time. And, it's funny during times when values are really squishy and things aren't so great, people always use that phrase, oh, I don't want to catch a falling knife. Well, nobody's used that expression in New York in I probably haven't heard that for 3 years. So I think that the market generally is coming back doing pretty well. We just need the volume figures to catch up with the optimism that's in the market.
And that is very well said. I love that. It's the bottom of the market, or at least toward the bottom. It's that courage piece to get off the sidelines and actually take action in the moment that people are going to look back and say, damn, I wish I would have bought that deal. I think some people are just missing that piece.
Man, it's
Bob,
impossible. It's impossible to time the market. I have some clients who got in probably a little too early. And those early purchases they made, they've lost those buildings to foreclosure already,
Yeah.
but they're still buying and doing well. And the deals they bought over the last couple of years are all going to be tremendous home runs for them.
If you had one last piece of advice that you would tell an agent, you got to show up and do it every single day, what would it be?
The most valuable and the most high powered activity that a broker can do is making prospecting calls. People refer to them as cold calls. I say if you're just randomly calling people all day without a plan, that's you're going to be making cold calls for your entire career. If you pick 1,000 or 1,200 people and you just call them over and over and over again, after a year or two, they're warm calls, they're not cold calls anymore. You have to time block at least 2 weeks in advance, block out 15 hours a week to do nothing but make prospecting calls. Don't let anything get in the way of that. Make those calls, go meet people, have something of value to talk to them about, know your market so that when you invariably are asked that question, hey, how's the market? You can spit some statistics out rather than talking about the market in adjectives. And I think, provided you're doing fundamentally the correct things and you're doing those things over and over and over again, eventually it'll work for you. Eventually you'll find success. You just have to have that ability to use discipline well. I always say use discipline as opposed to have discipline, because we all have the ability to utilize the same exact amount of discipline, but we all use it differently. But if you can use it well,
Mhm.
doing those things over and over again, eventually success will be yours.
Yeah, it's that consistency will equate into your intensity of what you get back from the market. Man, Bob, I appreciate you being on so much today. As we wrap up, here's what I want to underline because it matters is that conversations like this is why the commercial blueprint exists. It's not to chase predictions or to amplify noise, but to give you perspective you can stand on, even when the market feels a little unstable. Bob, I so appreciate your ability to take today's market condition inside a much larger market timeline, especially in an industry that too often kind of forgets its own history. What you've shared here, I think, really enforces a simple truth that cycles don't reward panic or passivity, they reward discipline. That we're going to use discipline, preparation, and professionals who know how to think. For those listening, this is the work, understanding where we are, how we got here, and what behavior this moment actually calls for. Markets change, but our standards don't. And Bob Knakal, thank you for your time. You are clearly someone whose standards have never failed because you stand on them and you show up with them again and again.
Well, Alicia, thanks so much for
Appreciate
having me. I
you.
wish everybody out there the best of luck.
Awesome. Thanks, Bob.